Hello, everyone. In Chapter 11, we're going to cover stockholders' equity. Now, recall from Chapter 10, we covered liabilities, which is debt financing. In Chapter 11, we're going to focus on what is known as equity financing and focus on the stockholders' equity section of the accounting equation. We'll first look at the different type of major organizations. We'll first look at corporations. And when you have corporations, they may be not-for-profit, for-profit. They could be what's called a publicly held corporation or a privately held corporation. So if you are a not-for-profit corporation, your purpose is not to earn a profit, but to provide a service to the general public. So organizations such as the Salvation Army, the American Cancer Society are examples of not-for-profit organizations. If you are a for-profit corporation, your intent is to earn a profit either from providing services or selling products to your customers, or it could be a combination of the two. So companies such as Facebook, IBM are examples of for-profit corporations. Now, when you are a profit or a corporation, you can be publicly held or a privately held corporation. If you are a publicly held corporation, such as a Facebook or IBM, it means that anyone who has the financial resources can become part owner of your corporation by buying stock. When it's a publicly held corporation, it means that organization sells stock on an open stock exchange market. If it is a privately held corporation, you are not able to acquire stock on the open stock exchange market. For a privately held corporation, those stocks are going to be owned normally by the owners of that corporation and probably family and maybe close friends of the owner. So Cargill Inc. is an example of a privately held corporation. You have to go through that corporation in order to acquire stock in that company. Next, we take a look at the characteristics of a corporation. And you can read, so I'm not going to necessarily go through each of these different characteristics, but we'll look at some of the advantages and the disadvantages of having a corporation. So when you have a corporate form of status, whether an S corporation or a C corporation that we'll talk more about, it is a separate legal existence, which means the owners are separate from the actual business. So in the case of a lawsuit, they cannot come after your personal assets because, again, the owners are separate from the actual business. With a corporation, it's very easy to, you have limited liability, meaning that as a stockholder, you're not responsible for the liabilities of that corporation. You can only lose the investment that you made by acquiring stock, but you're not responsible for the liabilities of that corporation. Transferring ownership is pretty easy for a corporation. You transfer ownership by selling stock. So when one person buys stocks and sells to another person, they're transferring ownership. So it's pretty easy to transfer ownership for a corporation. Ability to acquire capital. When corporations need money, they can sell shares of stock in order to raise capital for that business organization. Continuous life. They have what's called a perpetual lifespan, meaning that corporations can continue to exist forever. Because as you see, the stockholders are really the owners, and stockholders are going to be changing all the time. So a corporation has what's called a perpetual or a continuous life. Now, some of the perceived disadvantages of a corporation is things such as government regulations. There are certain requirements that a corporation has to meet because of the government, such as a public corporation must have an audit done at least on an annual basis by an outside entity. Then that's what they call the additional, excuse me, the additional taxes. Water break. This concept focuses on the fact that a corporation pays taxes on their earnings. A portion of those earnings are paid to the stockholder in the form of dividends. And then the stockholder pays taxes on those dividends. So when you hear about the term of double taxation, it's kind of misleading. Yes, the same income is being taxed twice, but not being taxed twice by the same entity. So first, the corporation does pay taxes on their earnings. Those earnings are then given to the stockholders in the form of dividends, and then the stockholders pay taxes on their dividends. It's known as capital gain tax. So in essence, yes, the same income is being taxed twice, but not by the same entity. It's first taxed at the corporate level, then taxed by the individual stockholders. Okay? When you talk about the government regulations, again, there are certain type of laws and regulations that are enforced on every corporation, sometimes by the state, sometimes federal. So the SEC, Securities Exchange Commission, again, has certain government regulations that every corporation are required to adhere to. Now, some may view it as being a disadvantage. For me personally, I do not, because I feel that every corporation needs to have some governing body regulating the actual information and reports prepared by these different corporations. Okay? So we discussed that already. Next, you have the typical structure of a corporation. This is the org chart for a corporation. But notice who's at the top. Yes, it is the stockholders. Because as a stockholder, you have certain rights. One right you have is the right to vote on who becomes members of that company's board of directors. That is a very important right that you have as a stockholder, because the board of directors will then select the president or CEO of that business organization. So if you are a stockholder with the right to vote, make sure you do research on those people who are trying to become members of the board of directors, because the board of directors, in a term, they're going to hire the president or CEO of that business organization. Then you see the other positions typically you have for a corporate org chart. Now, these first three will always be the same. This next section can vary from corporation to corporation. Okay? Now, there are other forms of business. So let me ask you a question. How many have the desire to run your own business? Okay? So it is key that you understand the business structure that would be the most advantageous for your type of business. And there are several types of business structures. There's limited partnerships, there's LLPs, there's LLCs, there's S corporations. I would encourage you to make sure that before you choose a business structure, you understand the advantages and the disadvantages of all of these different types of business structure. So I'll tell you that the most popular structure right now is the limited liability company. This form of structure came about in 1997. Okay, so with the LLC, you have the protection and the liability of a corporation, but you have the tax structure of a sole proprietorship or a partnership. So again, before you choose a business structure, make sure you understand the advantages and disadvantages of each of these for S corporations, C corporations, etc. Okay? So I'm not going to go through all of these next items, but it gives you instructions on how to become a corporation. It's a how-to type of section. And pretty much you must first complete an application with the Secretary of State. So whatever state you're trying to set the corporation up in, you would go to that state Secretary of State website, complete an application, got to submit things such as your bylaws, etc. And upon approval by that state, you receive what's called a charter, which means that you are now licensed as a business to do work in that particular business. You have been formed as an actual corporation. Now, the requirements and the fees, etc., they are going to vary from state to state. There are certain states who have more favorable laws than others, such as in Delaware, New Jersey, Nevada. They tend to have more favorable or more relaxed requirements for becoming a corporation. So companies sometimes will incorporate there. Now, normally, once you have a corporation, you're able to do business in any particular state. Although, let's say you may be incorporated in Missouri, that doesn't mean that you still can't do business in, say, the state of California. Now, once you have your corporation papers, you may have to obtain a business license in order to do business in those additional states. Okay. So one last topic that we're going to continue with the next video. As I mentioned before, when you are a stockholder, you have certain rights as being a stockholder of that business organization. Two of those rights include the right to vote. So as I mentioned before, as a stockholder, you're able to vote on who becomes members of that board of directors. That is an extremely important right because once again, that board will pick out the president and or CEO of that corporation. So you need to know that those board members have the best interest of the corporation, that they're looking out for your best interest. The other rights you have, the right to share in corporate earnings, what's called dividends. So often students try to record dividends as an expense. Dividends are not an expense. Dividends are payments to the shareholders of that corporation. So when a company earns a profit, they may decide to share a portion of profit with the stockholder in the form of dividends. And it makes sense because if you are a stockholder, you are a part owner of that organization. So if the company makes a profit, we're saying, where's my cut? Those are called dividends. Okay, so I'm going to conclude this first video here. We're going to come back with additional video on chapter 11. Stay tuned.